Monist view, and today we are going to discuss the long options. Long options are basically a derivative product which is exercised by very less investor with a long view. Long options in India is a profitable long-term derivative game or not? So let's discuss one by one. The first question is, what is a long option? Long options are a basic option derivative contracts available normally for index, which can be traded for long maturity. It has a huge time period for expiration, usually more than a year. If you want to see what are the options available, you can check out with NSE website. The some developed markets like USA, Singapore, the time limit of this long option is more than 5 years also, but it's based on a different aspect. The major limiting factor here is a margin, liquidity and volatility. So what is the current status of long options in India? In India, the main index is a Nifty 50 where we have a long options available. Nifty 50 is index tracking 50 largest company registered and traded in India with respect to a market capitalization. For Nifty 50 long options available till next 5 years, but with a different expiry. The different time period available are next 7 weeks, then next 3 months, then next 4 quarter and next 6 semi-annually. So through which the period covered are 5 years. This different time period available for trading, speculating or hedging based on the purpose of a transaction, but these are subject to liquidity available for the strike, current volatility and risk appetite. Let's understand the advantages in trading a long option. Number 1, wide range of a break even. Since the period of expiration is a long, the premium received for shorting the long options generally give wide range of a safety for break even. If you short straddle at the money for Nifty for 6 month expiry, then it will probably give a range of 1000 to 1200 points for the current trading level which the Nifty is trading, which is really huge and wide range. Second, less number of adjustment. As we discussed earlier, since the range for break even is wide, the number of adjustment required normally are less. Adjustment required only in case of a black swan event. Huge gap up or gap down are risky but manageable through skills and experience. Major risk would be a huge directional move followed with a huge volume. Number 3 advantage is a hedge with a weekly option. The possibility of unlimited losses can be taken care with a buying weekly or monthly option in the given series. It is very important to know your risk appetite. Hedging is a two-way saver here, since it will limit loss at the same time it will reduce a margin requirement, which is very important for long-term trading. Number 4 advantage is ideal for a part-time as well. Since we discussed about previous 3 points how it is helpful, it is clear that shorting a long options are a good option strategy as they provide wide range with less adjustment, and by reduced margin it can deploy with a less time. The time investment is low and can be done by a part-time trader as well. Many investors trade in covered call strategy for their stock to get a rental income. Same way they can also trade in long option as it is a less time bound. The 5th advantage is overnight theta decay. The people who make money in shorting the option by only 2 ways: theta decay or directional move with a delta. Long option will give you a theta decay, but it has a risk which will be discussed in disadvantages. So let's discuss disadvantages one by one. Number 1, margin requirements and margin calls. If you are an option seller, then you need a margin for shorting any contract. Recent rules by SEBI are providing no margin leverage but margin benefit provided for hedge position. The peak margin rules which recently introduced another recent changes where the margin call hits on regular basis for high volatility market condition. Second big disadvantage is margin double for every 9-month contract. If you short a long position, then the margin in need to be given, but if you traded a contract with expiry of more than 9 months, then the margin requirement are double to cover the volatility in the market. Suppose we are in a month of January 2021 and if we wish to short the Nifty option for July 21, then the margin will be X, but for the August 21 contract margin will be 2X. Third disadvantage is a high VIX and high premium. premium. The option premium generally derive its value from gamma, theta, rho, vega and implied volatility. The India VIX defines the general expectation of a volatility as a full market. If the India VIX increase, then the option premium also increase without respecting theta decay. In this scenario, it is necessary to take a decision to stay in the market or close the position. Long options are really a good instrument for trading, but speculation or hedging, its point of view of an individual investor. So what is a bottom line? Let's discuss a bottom line. The long options are new to a large amount of investors and many traders not involved in a long option because of a huge uncertainty and the fear of a black swan event. But yes, you can trade in a long options. So that's the video guys. Thank you for joining with us, and if you want to read the full article, the link of the article is available in the description.